Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the Market Site Desk this afternoon, we have Michael Normyle, U.S. economist at Nasdaq, as well as Chris Dearborn and Max Cabasso, managing directors on Nasdaq's Market Intelligence Desk. We're here to discuss if higher rates for longer are necessarily a bad thing. We'll also take a look at some early trends that are emerging in earnings season. It's great to have everyone here as always. And Michael, really, that's what the market's asking itself right now. We didn't get the 6 to 7 rate cuts in 2024 as expected last year. Are higher rates for longer a bad thing, though? It suggests to me that the economy is doing well and we're still growing.
Right, and that's the reason why we've seen that switch, right? It's generally been a combination of stronger economic data signaling stronger demand, and then also higher than expected inflation data. So if the trade-off is that we're having strong economic data, then it makes sense if we're not getting that inflation coming down too, because we kind of got the best of both worlds last year where inflation was coming down and the economy was holding up. This year, though, it's the economy's holding up, but inflation also holding up now. So it kind of makes sense that we might need to keep rates higher for longer, but it's kind of for a good reason if you want to put it that way.
Chris, do you think too much is made of Fed policy and the broader impact of what's, $27.5 trillion economy in the U.S.? By the way, we have some key pieces of data coming out over the next 2 days, too.
You can't fight the Fed, but you know what? You can't fight the stock market either, right? You've got the consumer's been pretty strong, right? We've talked about, but we've seen some cracks in the armor. I mentioned that in the past. But you've got, low unemployment, wage growth keeping pace with inflation. That bodes well. But what you're seeing in the different tiers of consumers, at least on what I've been reading recently, is that you're seeing people starting to trade down, right? Low-income workers, which were benefiting from like the SNAP and everything else, that's starting to get hurt a little bit, so they're not spending as much. Middle class is trading down to lower items, and they're going to the dollar stores or just doing without. And the upper class, while still spending is strong, they're shifting to leisure and experiences, but also they're starting to get hit with some of the employment, because that's where some of the layoffs are coming in the tech space in that area right there. So that's starting to get a little bit hit too. So when you put that all together, the consumer's still relatively strong, keeping pace, but it's kind of squishy, right? They binge on birthdays, they binge on Super Bowl, they'll binge on holidays, but they're not trading up all the time. So can that continue to move forward? It's tough to say. On the markets, we hope hyper-focus on the Fed. It's been controlling monetary policy for a long time, and the backbone has been a strong GDP. And the consumer, the reason I'm bringing it up is because the consumer is the backbone of this GDP.
Right. Well, they certainly are. But Chris, on the other hand, too, with interest rates going higher, we're also seeing credit card delinquency rates go up. What was it, 3.1% at the end of 2023? That's the highest level in 12 years. They're going to get squeezed at some point.
They're getting squeezed. I mean, look at mortgage rates.
But it's hard to bet on the consumer, though.
Yeah,
right?
I mean, look, we've kind of held up in the face of everything. I know, Joe, we were talking earlier. You look at the spending. I think it was Marshall Plan in the 40s versus now percent of GDP. How much has actually come out? The most recent, spending from COVID to the Inflation Reduction Plan, whatever you want to call it. It was, something close to 20% of GDP we put out there. So there's a ton of capital that's out there. Again, we had zero interest rates for years. Now we're kind of getting back up. We're above kind of where we were historically. It's not like we're crazy though. So kind of having to work that way out. But again, there was so much cash in the system, so much money flying around, and you could borrow at no rates. There's always talk about people with their houses. All right, I'm locked in below 3%. I'm not going to sell it here. So where you would think those rates, the elevated rates, okay, housing's going to start to get hurt. We're going to start to see that make an impact. People are just like, well,
I'm just doing. I'll refinance
I'm good.
later.
I'm going to refinance later. I'm going to stay here. I'll reinvest in the house versus moving. I'm going to build something in addition versus going out and buying a new house. So we haven't seen that really trickle down. So it's almost a sense of, because of how much support there has been for the economy, that the Fed's tools have kind of lacked the punch that you'd think they normally would, because of the amount of support, and it's not hurting as much because we've had so much of a backstop. Again, now we're starting to see, like you talked about, credit card delinquencies going up. Something to obviously continue to watch. Does that trend continue, or are we going to see a peak? That's what we're going to need to see, in the next couple months here.
Don't you think it's more like a return to normal, though, from the pandemic gold rush, I guess, for lack of a better word?
But you could also make the argument that what we saw the prior 10 to 12 years following the financial crisis into the pandemic, where you had stocks at the bottom left to the top right of the chart, you had so much liquidity in the system, you were near 0% interest rates, that is not normal. So, so Michael, what is the baseline for normal then? Prior to low interest rate environment, let's call it 2008, or what's the baseline for normal these days?
I think that's a fair way to categorize it. I think, we thought initially people were thinking post-financial crisis, that was the new normal, right? And now it's starting to look like, okay, maybe that was the anomaly, and it's really the pre-financial crisis period. That's when the economy is behaving normally. And the economy's been slowing. It's just, to a decent number, kind of normalizing, like you're saying, where we're looking at, we get GDP tomorrow. Could it be 2.5% to 3%, which is a solid but not blowout number. So we're getting back to kind of a normal kind of levels here.
Yeah, on a historical basis, though, even though rates feel higher, they're not like they were in the 80s when Volcker was presiding over the Fed. And I think the Fed administration, that we have in now, they're going to be highly sensitive to reversing course too quickly.
Yeah, but also comparing now to the 80s, the economy
it's apples and oranges.
Yeah,
right.
It's so different, right? And if you look at kind of what markets kind of think should be where the Fed eventually gets to, we're looking at 2.5% to 3%, somewhere around there. But back in the Volcker days, that was a much higher kind of number. So it's all relative to what the sort of neutral rate is. And so right now we are still pretty restrictive with rates at 5.5%. So that reversal definitely does need to come because the risk is getting more two-sided. The Fed has talked about it, although with the last few months of inflation data, they've been kind of stepping back closer to worrying more about inflation again.
Well, let's put a chart on rates here for a moment, or even take a look at at the 10-year, because I think the velocity in the moves is really where the focus is.
Yeah, we've seen it. I mean, you could see it here again on the 10th when we had the inflation come out. We went from 4.35 up to over 4.5, 4.55 essentially. 20 basis point move in a single day on a 10-year note is pretty crazy. I mean, I don't want to say it feels normal at this point, but we've seen so many of these kind of large moves where just a single data point has a massive impact on rates. But that 4.35 level was a pretty big one. We got right through it over 4.5, held that. And now we're kind of going back to those, early November, highs from 2023, which is where we kind of peaked before coming back off. Now, if we get back to 4.65, again, it really kind of looks like that 5% level is back on the table. Obviously, we have, PCE coming out, which is the Fed's, the data point that they like to use more than CPI. So that'll obviously be a big one. We have GDP as well. If PCE comes in hotter than anybody expects, and if GDP beats as well, I would not be surprised to see this, break through this 4.65 level back up to 5, and pretty quickly. Again, that move index, the velocity of these moves is pretty substantial. Where you're normally expecting a few basis points a day, we're seeing 20 basis point moves in a single day, and I think that catches not just the bond market, but the stock market kind of off guard when you have such a sharp move. That's why you're seeing kind of reversal in stocks when those hit, because it's, wait a second, it seems like we're way off sides here each time each data point we get.
Right, well, and it's interesting because we are starting to get into the thick of earnings here as well, Chris. I mean, removing the Fed, some of the losses that we saw from the open this morning, tech is outweighing some positive earnings reports that are coming out of other sectors.
The top 5 in the tech really, 95% of the earnings in the S&P. And what you're looking at there is, you got about 35% of the S&P reports this week. So we've had a decent segment. The earnings thesis isn't broken yet. Banks were okay. You're seeing today a couple of big names report last night and this morning, and they've reacted well, but they didn't react well because of what they've done. They reacted well, for the most part, because of what they're promising in the future. So what you're looking at is guidance. Right. Companies that have performed well don't always get that earnings pop anymore. It depends on what they say moving forward. So if they're a company that relies on raising money in the open market, they're going to get hurt. If it's a company that projects to do savings down the road, they might get a bump. But if it's a company that's growing their business significantly, anything AI, some of the EVs we're promising here, consumer, to a point, you're looking at potentially good runs for them. If you look at the Russell 2000, they're down 6.5% for the month. Right, the S&P's off 4%, give or take. Nasdaq 100's down over that so far. We gave back all the gains we had this morning. We're trading flat to negative after the open. It all depends on the market. But the problem, what's going to happen on Thursday into Friday, is that you're going to have economic data that can move the market, and you're going to have companies that are reporting that can move the market. And if they're all in the same boat, the market's going to have a huge move one way or another. But if it's mixed, you know, we can end up flat in the same boat that we're in, with generally stronger growth here was okay, but the earnings are kind of iffy. You know, 3% for the, you know, I don't know. I don't know if we get that.
Well, I mean, Michael, as you very well know, you have to be able to justify the multiples that have been awarded to stocks. You know, look at the performance over the first quarter.
Yeah, I mean, obviously valuations have been pretty strong for the big kind of mega cap tech companies, and they have to justify that, and a lot of that is AI related. So it is, you know, each quarter is going to be kind of testing that thesis like you're putting it. So
right.
we'll have to see if AI can come
I mean, Max, but you're seeing what's happening, this rotation out of tech moving into sectors like energy as an example.
Yeah, energy, industrial. So the chart I have here is the semiconductors, and the reason we're looking at this one, today's price action, we kind of broke out or kind of regained some footing earlier in the day, and we've since given it all back. Semis have really been the leader here, you know, essentially for the first quarter. Obviously, we have the NVIDIAs of the world that are you know, the big headline grabbers, but semis are a huge part of the AI thesis. They've really been leading here, and we failed to break out, you know, back from this range, kind of coming back in. You know, it looks like we're going to test this 42.25 level, which is again kind of where we closed 2023 at. Which, if that happens, we're giving back essentially all the gains we've seen in that first quarter in this space. Again, so starting to see that rotation. Maybe people taking some profits off the table from what they had already. You've already kind of rolled over. You saw it again this morning. Momentum really faded. We're at the lows now of the day. Wouldn't be surprising to see this close, you know, in the red. You know, as they're kind of again rotating a bit into some energy names, into industrials. They're reading some of the earnings reports today. Sound like there was a bit of an uptick in demand from the industrial, so potentially, you know, a little pickup there. And again,
but that makes sense, though, right? You have supply chain concerns, of course, but then if you don't have enough power for these advancements that are coming out in the tech space, you need the semi chips, you need the warehouses, you need to be able to power these AI type of products that rely on semis, right? So think about it. What's the next iteration of that? Who is supplying that energy, right? Where is that coming from? Whether it's an infrastructure play, power grid play, traditional energy play, right? Because, you know, with the energy companies that we have had on talking about the energy transition today, it's not an either or one type fits all solution. Electricity is not going to solve the problems world. It's more about the portfolio of solutions. And I think that could potentially be a catalyst why you're seeing this rotation into energy.
yeah, for sure. Again, that the semis got that kind of early tailwind, and now as we start talking about the energy and people start actually coming to the realization, like, yes, we do have to power. We're not going to be able to do this all on renewable. You're going to need oil as well to perform. You also have geopolitical issues going on there, which could, you know, help drive oil even higher. So again, you're starting to see that rotation. So maybe the gains are kind of, or now we got the gains that we saw in the semis in that space, and now, okay, what's the secondary effect? What are the knock-on effects? Who else is going to benefit from this? Who's going to have that increased demand? Because of that, and it kind of points back to energy. Again, we're down a little bit today, but not terrible. You know, so this is XLE here. Again, we're still looks pretty bullish to me. We topped out just below 100 early April. It's a bit when we started to sell off after the Israel, Hamas and Iran conflict started to get not watered down, but it seemed like it wasn't going to be escalated. Obviously, that's potentially back on the table as we're seeing. We just got new funding, for Israel and Ukraine. So again, there's a bull thesis there for energy. Not just so you have kind of multiple tailwinds there. Again, powering AI, powering the semis, powering all the data centers, as well as any geopolitical conflicts. Obviously, we're going into the driving season as well in the summer, where people are going to be traveling more. So yeah, there might be a bit of that rotation. We'll see, obviously, what earnings, what they say. But even in tech land and kind of what I've been reading, it seems like this is going to be a beat and hold type quarter for tech versus beat and raise. Kind of tempering expectations for the back half of the year, where those comps year over year get more difficult. First quarter versus last year is easier to beat. Fourth quarter is going to be a bit tougher because of what we saw, obviously last year. So kind of tempering expectations for the back half of the year, maybe slowing down a little bit. Again, beat on the top line, but again, the guidance might not be there to see those real bull runs in those spaces. So again, kind of looking for what's next. It makes sense. Again, industrials, energy seems like a good spot.
All right. Appreciate the insight as always, guys. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.